As the world is gradually coming out of the peak of the pandemic, we observe that 2020 has seen a very strong performance for various investment funds, such as hedge fund and private equity. So in terms of the number, let's talk about hedge fund first. Hedge fund asset under management has been has grown to $3.6 trillion, which is almost equal to the German economy, which is the fourth largest in the world. Further to that, we also expect there will be around $700+ billion of allocation across different asset classes within hedge fund, and there will be another $35 to $40 billion of the new investment also in this fund type. In addition to that, private equity has also seen an explosive growth this year in 2021. 740 billion worth of investment has already been made in first 5 months of 2021, which is very similar to the massive PE performance and investment in 2007. In last 14-15 years, PE has not seen this kind of massive growth and investment. This is a glimpse of what we can expect in 2021 and years to come. Investment is flowing. There are various a big amount of dry powder to be invested, and capital is abundant. So in this case, it becomes important that the professionals in investment banking, the fund accounting professionals, develop right skill set to perform at the optimal level and rise to the expectation of the industry. In the fund accounting industry, the investor allocation, investor accounting is critical because it deals with the numbers and the allocation to investor, and it has to be accurately performed. That's why investor allocation and accounting has to be properly understood by the fund accounting professionals in the investment banks. So hello and welcome. My name is Nidhish Singh. I'm chartered accountant and member of ACCA, CISI, Institute of Director, and I have 16 years of experience working with investment banks such as Citibank, JP Morgan, State Street in India and UK, Ireland, Hong Kong, Singapore, various countries. I'm also a PhD level researcher in private equity and hedge funds. So these are my area of expertise. So let's talk about what are some of the nuances of investor allocation and calculation of the fees and their allocations, basically. So two key items which often confuses fund accounting professional are series and equalization accounting. So let's first talk about equalization accounting. So as an example, we can consider person A, which invests into a fund, and the fund value to start with was $100. After the investment, fund makes a profit and it rises to 110. The investor A will be charged 20% on the increase, which is $10, right? The fund grew from 100 to 110, so $10 of increase. So 20% of the performance fee will be charged on that. So $2 is paid by the investor to the investment manager. Now, the next month, fund made a loss and it came back to 100. At that point, investor B thought it is a great fund and it's the right time to invest. She invested into this at rate of 100. Fund rose again to $110. At this stage, at the fund level, there is no profit because fund was already at the highest watermark or a highest level of 110. Now again, after the loss, fund has reached to 110. So in reality, fund has already paid incentive fee at the fund level because the highest level was 110. So fund has just gone down and gone up. So it is still at the same level. It has not exceeded the previous benchmark. So no incentive fee. However, in this case, the investor B has earned from 100 to 110. It has made a gain of 10%, but is still not paying incentive fee. Whereas the previous investor A had to pay 20% of the growth. So investor A is disadvantaged. Investor B, which came later, has got a free ride. This is called free ride, when they made a gain without having to pay any incentive fee. So these are the situation, that is the situation that we need to avoid when we do equalization accounting. There could be an opposite situation as well, whereby the investor could have come at 110, the investor B could have come at 110, and the fund next month could have gone to 120. So in that case, the investor will still have to pay $20 times 20%, so $4 at the overall fund level. So whenever investor B, the later investor, has to pay excess incentive fee, that is not fair with the later investor, investor B, because it came later, but still it will be charged higher incentive fee. So that is called, and in that case, we give contingent redemption in order to compensate the investor B. So these are some of the situations whereby equalization accounting has to be has to weigh both type of investor and ensure that there is no free ride to any investor. So let's take this and let's take an example to understand this step by step. So I'll just share a screen and explain you. So in this example, to start with, investor A comes and pay $100. Fund goes to 110. That's the value of the fund. They have to pay 20% of growth or increase in value, which is $2. Now fund goes back to, sorry, this goes back to 100. Investor B take up the opportunity to invest at a lower price. So she invested 100. Now the worth of fund is, so total investment of the fund is 200. And this investment overall goes up by 10%. So the fund, which was invested originally $200, now 220 altogether. So 220 is the new value of the fund. So divided by 2 shares, each share worth $110 now. In this case, we know that fund highest NAV was 110. Hence, even though fund reached to 110 again here, there is no fee required to be calculated at the fund level. However, we understand that the investor B came at 100 and the fund has grown to 110. So investor B made a gain of $10. But are we charging anything to investor B? No, because the fund's highest watermark is, our highest level of the performance was 110, and we can't charge anything to the fund, and hence investor B will get a free ride. So what we need to do? We will charge investor B a fee here, and that will be called a contingent redemption, because investor B came at the lower level of NAV and has made a profit yet not paying any fee. So investor B has to pay a contingent redemption. And how do we calculate that? So let's take an example. So that fee will be, or contingent redemption will be equal to fund's highest watermark, which is 110 coming from here, and funds investment, the investor statement, investor's investment, which is $100. What is the difference? 10, right? What is the fees rate? 20%. So the investor has to pay $2 per share of investment. So if investor B would have invested, say 10 shares, then it has to pay, she has to pay 10 times 2, $20 as contingent redemption at the start of investment, so that the investor B do not get a free ride by any means. So this is the concept of contingent redemption. We can also quickly understand what is the equalization. So for understanding equalization, let's start with investor A again. He started with $100. Fund grew to 110 and paid 20% of increase or growth, which is $2. Now again, investor becomes and it invested 110 to get one share. Fund grew to 120. How much the fund will be charged overall? Fund will be charged, because crystallization has not happened, so fund will be overall charged 120 minus highest watermark, because the fund watermark remains 100 here, because there is no crystallization so far. So $20 difference. B will pay 20% of $20, which is $4. Now, in reality, investor B should only pay 20% of the difference, which is 120 minus 110. So it should only pay 20% of $10. But since the fund incentive fee is in equalization accounting charged at the fund level, not at the investor level, not at A and B level, it is charged at the fund level. So overall capital will be charged 20% when there is an increase in the value. So even investor B has to pay 20% of the fund's highest watermark or the highest value minus the value at which the crystallization took place. So that was 100. So altogether, if it is paying 20% on $20, it is unfair with investor B. It is fine with investor A because it had come at 100. So it is okay to pay 20% on the 20, but for investor B, it is not fair. So we need to compensate investor B, and we will give her an equalization credit equal to the amount for which she is charged unfairly. So 20% of $10, which is 2. So $2 per share will be given to her. It will be given a credit to her, right? In this case. So this is how we make the adjustment for equalization credit and contingent redemptions based on the movement and direction of the fund's growth or reductions. So overall, this is a high level explanation of contingent redemption and equalization. Also, there is another way of accounting this, which is much more simpler. It's called series accounting, whereby we will maintain let me remove this. In series accounting, we maintain kind of a swim lane for investor A, then investor B, investor C, and D, etc. So they are called all separate series. They are all separate series. So every time an investor like A, B, C, or D comes, they will be investing their capital, say 2 million or 5 million, and we will maintain say 6 million or 2 million again, right? And we'll maintain a different capital as if it was a new fund being launched. So since all the capitals are maintained separately for each series and each investor, then we don't have to make any adjustment for equalization or any ups and downs in the capital, and there will be no unfair treatment with anybody. So series accounting is much cleaner. But yeah, of course, after some time it becomes tedious because there will be several hundreds of investors after a few years in the fund. So both types of accounting has its own pros and cons. And in equalization accounting, basically, we maintain the same NAV price across all the investors, and we only report one NAV, basically. That's why we need to make the adjustments for each and every investor that when they come. So this is a high-level understanding of the investor accounting methodology. Of course, when we do at the industrial scale in the workplace or for any large multi-billion funds, it is much more detailed. We need to maintain massive Excel tracker or application. There are various system accounting platforms like Geneva, Investron, eFronts, etc. for hedge fund and the private equity funds. Despite all these applications, we need to understand how things work, and there are detailed steps to do the proper calculation. We need to take into account high water mark for the fund level, and then for each investor, how the fund is moving. So there is a lot of detail that we need to understand and the practice. So I'm going to discuss all these accounting methodologies in much more detailed in a much longer session in future. So if you want to understand and learn these accounting methodologies further, I welcome you to approach and block your seat. The training and the detailed discussion will soon start by 28th of this month, 28th of June, and it will be beneficial for you to understand in detail, step-by-step manner, all the accounting methodology. We'll talk about the difference between the series and the share classes. What are the how when share classes are launched versus when series are launched, and what are the hurdle rate, IRR, what are different way of calculating incentive fees. All other fee calculation methodologies will be also discussed in that session. So I welcome you all to join that. Of course, seats are very limited so that we have a very productive and focused discussion. So please feel free to block your seat in advance, and see you in the next session. Thank you so much, and let us know if you have any further question.